Hey, I hope you're doing well. Today I'll be talking about Wynn Resorts. As you can see by this chart in front of you, Wynn has had an interesting history with going as high as $250 to as low as $42 during COVID. I find this as a very interesting opportunity in both that the value is really good and there's potential for revenue growth. Also, it's a dividend play if you're interested in that aspect as well. Good dividend grower as well, except the COVID period. But, obviously it's a resorts company, so it was going to get hurt by COVID anyways, as you would imagine. All right, let's talk about their cash flow. As you can see, the cash flow has been pretty steady. I mean, here it's negative, but this is obviously COVID. So please avoid these numbers over here. Let me bring you to more closer numbers, which are 2024 numbers, where they generated $1 billion in free cash flow. And their valuation at the moment is about, well, let's say $9 billion. I mean, today it's down 30%. So $9 billion capitalization, about 1/9 free cash flow yield is pretty good. But let's use levered free cash flow to get a more precise generation of cash flow for shareholders, which let me find that. Just give me a moment. It's down here. The levered free cash flow is about $650 million. This is the cash flow this has already paid off all expenses, all necessary taxes, everything. So this money could be utilized for either dividends or stock repurchases, which they have done both. They have repurchased stock, especially recently because the management team has been very excited about their long-term prospects in terms of revenue growth. So they think the value at $80 is immense. As do I. I do believe there's a strong revenue growth potential, and I will actually get into this right now. So as you can see, these are the locations around the world that they have. And specifically this one right here will be built in 2027. Why is this one so special? Well, this one is special because it will be a monopoly. It will be the only casino in the UAE that is allowed by their regulatory board. So this enables them to have a first-come advantage. And two, I believe they won't have any competition until like 2030. But even then, the management team said there's no visibility of new entrants. But who knows? Maybe they will come by 2030. That's my expectation. So they will have like about a 3-year lead on the competition, which will be I believe they will have the highest margins of any location that they have at the moment. That's why they bought Wynn Mayfair. Well, they didn't buy it. They renamed it Wynn Mayfair, but the acquisition was Crown Summing. This is a members-only casino. This enables them to create deeper relationships within the region to attract people to come to this one in the UAE. I find this location to be very special. As I've said, it is going to be a monopoly when it enters the market in 2027. So, yeah, obviously this will take some time. This will happen in 2 years. At the time of recording this is March 28th, 2025. But like I've said, this location will have the highest margins, the potential of this one to generate good revenue growth. The return on investment in this location will be absolutely huge. I do believe that. And speaking of which, I do want to talk about margins because this company has very, very good margins. Okay, let me find that. Here we go. If we take a look at the EBITDA margins, because these are less volatile, this enables us to look at the specific prospects of Wynn. As you can see, in 2024, the EBITDA margins were 26%, which are incredible. The reason why I'm not using net income margins for Wynn is because they are in the process of investing into properties. So their net income margins can be a little volatile because of that reason, because of increased capital expenditures. However, this is a long-term play, so I'm not too worried about net income margins. I do believe net income margins can increase sizably, especially because of the new location that they're building. But if we take a look at the potential risk to margins, if in a case maybe of a recession or tariffs, because they can be hurt by Macau, which I will speak on a little later. That's one of the risks that comes with Wynn. But at the moment, let's talk about margins. So I believe your risk in margins, the lowest point they can come to for EBITDA, which is about 18%, as you can see in 2018. The reason why I'm using 2018 as an example is because in 2018, we had a tariff fiasco, the same one, or let's say pretty similar to the one we are going through right now. And they were hurt by this one because about 60 or about half of their revenue or profit, well, not profit, but revenue comes from Macau. And in 2018, the tariffs imposed were on China, and most of the travelers to Macau are from China. So obviously they were hurt by the tariffs. They were spending less, and thereby Wynn was hurt. Apologies, I hit my mic. But as you can see, they were able to weather the storm pretty well. But now they're having capital expenditures regarding new projects. Additionally, there's another project planned. This one was spoken about on the earnings call, which is they're planning on getting the license to build a casino in downtown Manhattan. I'm not very bullish on them getting the license in the first place, nor am I kind of excited for them to build it, because they said it was going to be around $8 to $12 billion project, which the company is $9 billion right now. I don't know how feasible that project is in the first place, nor do I think they are able to get the license, because the locals are very, very against this. They do not want a casino in Hudson Yards. And now let's talk about the potential risk, which I briefly touched on, which is the Macau risk. And as you can see, about 51.66% of revenue comes from Macau. The thing is, Macau is a bit more volatile than the United States revenue, and the profits are a bit more variable in Macau as well, as is the revenue. So in Macau technically has higher margins in the good times, but significantly lower margins in the bad times. So this one is a volatility factor within the company. However, I do think, regardless of what happens in Macau, the valuation on this company is incredible. Yeah, we take a look at the PE. It's relatively higher than in 2023. Well, actually, in 2023, the stock was in the trough here. So it was lower. It was fixed at $56. So that's not a really good point to talk about. But I do believe the valuation is good in terms of a free cash flow yield. It's around, if we utilize the levered free cash flow yield, it's about 6.5%, which is really good. Most of the time, it is around 2 to 3% is a good range. You go above that, it's an incredible deal. For example, I believe Google is around 2% as a relative factor, although Google has its own risk, and that will be a completely different video. I will talk about it at a later point. However, there's another risk I do want to talk about, is it has a lot of debt. They have managed it incredibly well. As you could see, it has declined from 2023 levels, which was around 13.42 billion to about 12.27 billion in 2024. I do believe they will keep on repaying down the loans, although it will increase due to the new project. But I'm not too worried about it. It's a great opportunity, and I'm not really too worried about it. But this is one of the risks within this company. It is very leveraged in terms of their debt. However, their margins and net income and cash flow are absolutely incredible, so I'm not too worried about it. And as I've said previously, their margins in 2018 declined because of the tariff fiasco. So if we, combine both the tariff fiasco in the future, potentially forcing us into a recession, or Macau is getting hurt a lot, that free cash flow can halve at least to about 500 million. But even in that situation, I would expect the rates to come down, their debt to become cheaper to repay or to finance. So I'm not too worried about it, and I do believe the free cash flow is pretty safe. And because they're leaning into the more wealthy, it is a bit less variable in the United States. However, in the Macau area, it can be a little volatile, and that's mainly why I would say free cash flow would have. And if we take a look at the margins, margins declined from 2017 to 2018. Specifically, the EBITDA margins went from 23%. Over here, 23% to 18. Margins can decline more in this specific situation because in 2018 to 2017, we didn't have a recession. And if we did have a recession, I don't believe it would be a financial recession. This is kind of a different topic. This is more macro, and I will speak on this in a different video as well. But in terms of what I expect in the next upcoming recession, and if we do have one, it will be kind of shallow and not very deep, and definitely not a financial recession. Another thing I wanted to talk about is the dividend. So the dividend here is only 23.41% of total payout or total retained earnings. So this has a very strong potential of growing in the future. I wouldn't be surprised to see it in the 60s to 80s, maybe even higher value, or put in the value of the future revenue growth as well, and how much that will yield as well. Then the payout could be immense. I mean, we're looking at what, 4% in the future. Well, if you utilize current present value, then yeah, it could be a strong payout. So this is why I'm personally looking in putting this one into my Roth. I'm obviously can't give any recommendations, and at the moment I do not own any shares, but I am looking at a potential entry point, and especially because today it's down 3%. However, the reason why I'm still waiting around is because I don't know what's going to happen with tariffs. I mean, it's honestly changing day by day. Honestly, day by day, hour by hour, we find out some total crap. But I am still looking at a potential opportunity in acquiring some shares here. And I'm going to put it into my Roth because of the dividend. I don't want to pay taxes on this dividend yield. I would like to potentially reinvest this and have a natural compound rate. This is why I find this opportunity so good, is because the natural compound rate, because of the dividend and the potential revenue growth from the UAE property, could be huge. I mean, natural compound rate of like 4 to 5%, not including the potential appreciation in the price because of their buybacks of shares, and reducing the float, and potential EPS increasing because of a decline in total outstanding shares. I mean, I'm super excited for this one. I hope you are as well. And if you enjoyed this one, please like, share with anyone who might find this helpful, and please subscribe, because you don't want to miss out on a potential opportunity that's going to come your way. And yeah, have a good one.